I'm Billy Caterly, and this is my lovely wife, Acacia. And yes, we retired January 91. We're into our 31st year.
Been retired 7 years, and I am living in Raleigh, North Carolina with my wife and 3 children. And we own a house here. And I got started investing right out of college around age 24, 25.
My name's Joe. We retired right before I turned 30. I was 29 and Allie had just turned 29.
Yeah, and Allie Olson.
So in terms of asset allocation, my portfolio is about 90% stocks, and that's spread across U.S. and international index funds. And the other 10% is bonds, total market bond index fund from Vanguard. So pretty plain, simple stuff. I don't really dabble in individual securities or try to time the market or anything. In March 2020, when I think we all saw a big hit to our net worths from the stock market crashing, I wouldn't say I panicked. I certainly pay attention to it in the sense that I watched about $500,000 shrink in about a month. So, going from about $2 million in investments down to about $1.5 million. That's certainly something I think anybody would pay attention to and worry about. I will say it's probably the closest I've ever thought about selling everything and going to cash or something safe like bonds. And so I had that thought for a split second of, I need to at least preserve what I have left. But then the rational part of me took over and said, this is long-term money. This is money I have invested for hopefully 40 or 50 more years of retirement.
We had Vanguard accounts, and we started buying Vanguard SPY, which is now SPY, Index 500 fund. And then as things progressed, then we switched everything over to ETFs back in the 2007, 2008 mini recession. And so we used that opportunity to get out of these mutual funds because they turned out to be more of a hassle for us than I liked. We were invested in 1987 when the market went down 20+% in one day. So, that'll put a crease in your pants, I'm telling you. And then again in 91, right in there was another big hit, and then 2000. Remember Y2K? Oh my goodness, yeah, we were good. And then we had the 2007 and 8 recession, and at that time we made these changes from mutual funds to ETFs because we had a big position with Vanguard in the mutual funds, and I sold off some shares because I wanted to reallocate them. And I went to do it again, and I had a 30-day freeze on that account. Yeah, for the mutual funds, and I said no.
Right now, we have 19 rental properties, and we're over our income. We're also over our target budget by quite a bit. There was a huge housing crash, right, in the Great Recession, and Vegas got hit really hard. And I was like, we should buy some rental properties. And this was in 2007, and it had started crashing in Vegas in summer of 2006. So it crashed for a year, and I was like, oh, look how cheap the prices are compared to what they were a year ago. So we bought a rental property, and then the price kept falling. And so then the next year in 2008, we were like, whoa, look how great the prices are compared to a year ago. This is a no-brainer. We bought another, kept falling. And so we were just sort of scrapping together money to try and get down payments. And after a few years, I had a spreadsheet that I sort of just went, all right, if we buy a house every time we have this much saved, and pulled down the columns and was like, whoa, we're not going to need to work at a certain point. And sort of realized that, and then stumbled on the early retirement community a year or two later.
Invest in you. Ready, set, grow. CNBC and Acorns.